Welcome to Traders Corner. Joining me, as always, is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, before we get to the bad news part of this show, let's start off by talking about the S&P 500, which has been very good indeed if you've been long the market, although it's quite interesting. I saw someone speaking at the SON conference in America saying that he would probably short the S&P 500 and go long emerging market stocks at this point. But just your thoughts on where this particular market is headed.
Yes, well, that's right. I mean, look, there's always differing opinions, and that's what makes a market, I suppose. When I look at the S&P 500, just purely from a technical perspective, it is looking to me relatively bullish still. We last recorded a show 2 weeks ago, and then obviously last week we had an educational show around stop losses. So if we just go back 2 weeks and look at what we discussed then and what's happened subsequently, at that stage I was looking for a breakout above this downtrend, and that actually did happen, as you can see. And I said it would probably push up towards 2,400, which was the previous high that we saw at the beginning of March, and that level was likely to be targeted, and possibly then a break beyond 2,400. Now, we're sitting right up there at 2,400 at the moment. That dotted line represents resistance over there. You can see that there's what to me looks like a bull flag pattern that's emerged over the last 2 weeks or so, and it started to break to the upside. So to my mind, that is starting to set up, I think, a possible break above 2,400 resistance, which could then take us higher, and I think possibly to 2,430, maybe 2,450, thereabouts. But overall, that to me does still look good. I think I'd maybe change my view if we started to break down below 2380. But for now, as I look at that and I see it, I think the path of least resistance is upwards, and the likelihood is we probably do see a break above 2400.
I mean, would there be any points in your view in going long the S&P 500?
Look, there could be. I think if you of the view that, like I am, that this is likely to break to the upside, and that the possibility is that the shorts would get squeezed if it pushes out through 2400, then there would be some merit in going long. But at the same time, I'm also not one that likes to chase a move. I prefer to sort of get involved during a consolidation or during some sort of a pullback, in a consolidation within a trend. So would I rush out and chase it through 2400? I don't think I would. But having said that, if you wanted to do it, you could do it probably with a fairly tight stop loss, and maybe there is 20 or 30 or 50 points on the upside to be had. But for me, I think I'll probably sit this one out at this stage, given where it is and given that the risk to reward ratio of chasing it now is not really favorable in my view.
And I suppose there is another contrarian indicator that you have at the top of mind, and it's something that you want to mention on tonight's show, and that's the volatility index. And funny enough, we spoke about it last night. It was one of the guests on Stockwatch's stock picks, well, a trade option, I suppose. But it's the VIX, and yes, known as the fear gauge of Wall Street.
Yeah, that's right. The VIX is the Chicago Board Options Exchange Volatility Index. It's a long name, abbreviated and shortened to the VIX, and what it really looks at is the implied volatility on S&P 500 options. When options traders are buying and selling options, volatility is a very important component of your pricing of an option, and when volatility is really low, that implies a market that's very complacent, and when volatility is high, that's when it implies a market that is somewhat fearful or nervous. Now, where we sit at the moment, there's a chart of the VIX. That's a recent chart looking back over the last 4 months, so it's a fairly recent chart. You can see a big gap to the downside on the VIX over there recently. And now what's quite notable is that it's traded for the first time in a very, very long time below the level of 10. And I mean, when we saw it down at 11 recently throughout February, March, and into April, we thought that was low. Well, it's gone even lower now. And just to put that into context, if we go back, now look at this is a chart going back to 1990. All right, so we're looking back 27 years over here. The last time that the VIX was as low as it is now was back in 1993. Right, so I mean, that's, I was still in standard 6 then, and
don't make everyone feel old.
Well, weren't you in standard 8?
Thanks.
Anyway, moving on. But just puts in context how low this volatility index is, and it's very, very unusual to see the VIX this low. And if anyone out there is having a difficult time trading in this market, trying to find moves that are just not really happening or not really following through, and certainly that's been my experience of late, you can understand why. The VIX is very, very, very low. But there are those out there, and like you said, it's a contrarian view that say, well, when you get the market as calm as this and complacent as this, it's the calm before the storm. And it might very well be the case. We don't know. But VIX at this low level is highly unusual.
Well, certainly looking at that chart, which, as you say, is 24 years worth of market history, every time it's that low, it seems to preempt some sort of spike in volatility. And I guess, well, not necessarily a downturn in the markets, although certainly in 2008, 2009, that's exactly what happened.
Well, that's it. Usually a spike in VIX, a spike in volatility is associated with a drop in the market, because markets are fearful when they're dropping. And it's that old adage, you know, the bull climbs up the stairs and the bear falls out the window. And historically, that is the case. Markets rise in a relatively calm, controlled fashion. Markets are quite forgiving on the way up, actually, but often when they fall much quicker in terms of speed than what they rise. And hence you get these big spikes up in volatility that happen when the market drops. So I suppose the contrarian thing right now would be to say, well, you go long the VIX at this point in time, because the likelihood of it going much lower from here is pretty slim. You go long the VIX looking for it to move up. And even if it was to normalize back to sort of 13 or 14 from the current level, that's a 30 or 40% gain in the value of the VIX. It's quite complicated. I'm making it sound simplistic. To actually trade the VIX, you would have to do it via VIX futures, and there's quite aggressive time value and time decay on VIX futures that you have to take into consideration. So that gets a lot more technical than what we're here to discuss today. So it's not quite as simple as just going long the VIX and waiting. Sometimes you do need to understand all the other intricacies involved. But certainly it does look to me as if buying the VIX now is probably a fairly low-risk thing to do, given that the likelihood of it going much lower from here is pretty slim. And
what about our own market, Garth? Because it's been unstoppable.
It has been unstoppable and driven only by a couple of shares, really. And Naspers being the main driver of our market, our large cap index at the moment, and Richemont being another one that also has been driving our market. Here's the chart of the top 40 index at the moment in our market, and you can see what I've spoken about numerous times on the show was this downward channel through January, February, and March that broke out to the upside during March. I then looked at the possibility of it moving above 45,500, which it did in April. Then last time we were here and we recorded a show, we were just bouncing up off that 45,500 area. And at that stage, I said it looked as if we were likely to go back up and retest the recent high at 47,000, and then we'd see from there. Now, what's happened over the past week or so, it looks like there's a small little bull flag pattern forming over there around about this 47,000 area, and that looks to today, in fact, it's beginning to break out to the upside. We're having quite a strong day on the market today. So that probably pushes us up to 47,500, maybe 48,000. In fact, one could even argue that this top 40 maybe stretches its legs a bit further and it actually goes to the prior all-time highs, which was at around about 49,000. So that's still some 2,000 points away, so let's see. But overall, this market, as you said, is fairly unstoppable at the moment. But the participation is actually quite limited. It's very much driven mostly by Naspers and Richemont mainly at the moment. There's not a broad participation in this market rally.
You are you feeling somewhat peeved that you cut out of your Naspers trade? You did very well in it.
We did do very well in it. Look, not really. I had a strategy, and I said at that stage we would monitor a trailing stop loss. If it went below the prior two-day low, we would get out and bank our profit. It did. It went below the prior two-day low at about 2,500 or there and thereabouts. We got out of that trade. We made good money. In fact, all our money for this year really was made on that trade, and it's gone higher subsequently. But that's fine. You know, you're very seldom going to get the entire move from the bottom to the top. I'm always happy if I get the rump of the move. If I get 50, 60, maybe 70% of a move in the stock, I'm happy to take that. To get the exact top and bottom, you've just got to be lucky, and yeah, we weren't in this case.
And maybe on that note, we haven't had a particularly lucky couple of trades. So the last two trades that you put on for the portfolio, long position in gold and also in the in South32, and those haven't fared very well. So let's start off with the gold price. Which
yeah, that's right. Look, I mean, trading is always a probabilities game. So we put our best foot forward and we do what we do in terms of the best analysis that we can come up with. But we know sometimes our analysis might not work out, and that's why we trade with stop losses. That's why we size our positions in the way way that we do, so that whenever we are wrong, we don't lose too much money. Unfortunately, this week, as you say, we've got 2 trades that have been stopped out, which has dented our portfolio a little bit, but it's not the end of the world. This is a chart of spot gold, and we went long in the early part of April when the gold price broke out through this resistance zone, which was at about 1,260. You can see that lateral resistance over there. That also marked a break above the 200-day moving average. And in my mind, that was a fairly bullish break, which was likely to lead to further gains down the line. It did rally, and it continued higher for some time thereafter, but then it began to consolidate through the late part of April. And then it found a bit of support at 1260 again, which was where the breakout had happened. And at that stage, I thought, well, it looks okay. Maybe we're going to bounce off that support and continue higher again. And that would have been an ideal scenario. It didn't work out that way in the end. And in the end, we were stopped out of the trade at $1,248 an ounce, which was a pity. But I say it was a pity. I mean, it's gone another $25 lower since then. So
$12.19.
Yeah, well, there we go. So another nearly $30 lower. So, it would have been worse. We lost $242 after all costs were taken into consideration over there. So not a massive loss. Obviously, it's disappointing to lose money. We never come here with the intention to lose. But trading is a probabilities game, as I said, and you've got to put your line in the water to catch a fish, and sometimes you get it wrong, and that's why our stop losses are there to save us. So unfortunately, this one hasn't worked. We lost a little bit of money, but that's trading, and you just got to march on and look for the next trade. And the thing about keeping your losses small is that it also sustains your confidence level so that you can then go out and do the next trade without fear.
I mean, because it's fair to say you could well easily have had a dent in your confidence, because the next trade was also a trade that didn't work out.
Yes, that's South32. So we did this trade in the middle part of April, and this is the chart of South32 up on the screen at the moment. What I'd identified was that the stock it was actually outperforming the rest of the resources shares on a relative basis. It still is, in fact, but on its own absolute merits, it's looking a bit weaker now. It broke out through that downtrend, which went back from December all right through the previous highs throughout the first quarter of this year. It broke out, and then came back, retested that break. It was reversing up from the 50-day moving average. You can see there's a little bullish hammer pattern over there. It looked as if it was starting to turn up and would start to resume its move higher. So we went long at 27 Rand 40 with a stop loss at 27.60. We were looking for a move up to 29.50 there. That did not materialize. You can see the share did move higher for about a week or so after we bought it, but it was very, very reluctant to go higher, and it almost formed sort of like a bear flag type of structure, and then before breaking to the downside again. On that break to the downside, we executed the stop loss at 26 Rand 70, which means that we got out with a loss of 1,754 Rand after all our trading costs were taken into consideration. So that works out at about 1.7% of our local trading capital. Not the end of the world. Obviously disappointing, but that's trading, as we say.
So Garth, you're not entering any positions this week, rather looking, scouting the market for something interesting?
Yes, I think given where we are, it's just, I'm not seeing a huge amount that's really tweaking my interest at the moment. So I'm going to just sit back for the moment, not force anything. We haven't had a good time lately, but that's not to say that confidence is battered, because we're still kind of flat for the year to date as a whole. Not a great start to the year by any stretch of the imagination, but it could have been worse. And we've still got our capital intact. I think kudos to our risk management, and we just continue to march on. What do they say? Keep calm and carry on.
Indeed. Have a cup of tea.
Yes.
So just a very quick wrap-up of the portfolio. It's still high in the South African portfolio, although not as high as it was, because South32 obviously dented the profits there.
That's right. So there's our South African portfolio at the moment. You can see it's up 4.7 for the year to date, sitting just shy of 105,000 Rand. And then there's our offshore portfolio. This is where the losses are hurting us a little bit. We're down 3.75% for the year to date. So we continue to look for opportunities to move forward here.
And very quickly to end off with, you've got courses still this month.
Yes, those are the courses up on the screen that you can see, Johannesburg and Cape Town, and then we also added a top 40 course in Johannesburg. If you'd like to attend any of these courses, please email me, garth@traderscorner.co.za, and I'll send you all the details.
Great, Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.